Okay. Now you guys should be able to hear me. Now you should be able to hear me. Let's remove that. Yes. All right. Here for the research. All right. Good, good. All right. So yeah, this stream, I'll just type a little message. Hey guys, won't be talking too much. Just gonna be sharing my screen for the most part and doing research if you'd like to watch or join along. I'll pop into chat every once in a while. Perfect. No, Daniel, I do not plan to sell out. Do not plan to do that anytime soon. Okay, cool. Well, I'm going to get started then. And, oops. Here, let me. Okay. Cool, cool. All right. Cool. All right. Talk to you guys in a little bit. I'm going to jump into some research and get started. So sometimes I like to use Google Trends and searches for auto loans, which is like a new product that Lending Club and Upstart and all these guys are trying to break into, are actually at a 5-year low. Fun fact. So that's not fantastic. Not ideal. So let's see. Personal loans. This one's a little more steady, maybe. Interesting. It seems to peak in June every time and like over the summer. That's interesting. Personal loans tend to peak during the summer. You can get some pretty cool insights from Google Trends. Personal. So this is how I make videos as well. I'm making a video right now. Interestingly. So what I see here is that usually it downtrends into the winter, like December, January. So downtrends into the winter, downtrends into the winter. So this downtrend into the winter doesn't look that abnormal. It's a little more stable than auto loans. But yeah, the auto loans one is a little more concerning. Let's look at Upstart. Dang. That's pretty good. All right, let's compare Upstart to Lending Club. So Upstart definitely more. I wonder how much of this is correlated to the stock though. But definitely more buzz around Upstart, both on an uptrend of sorts, depending on if this can get to a new high. What's interesting is that despite, well, I guess you can see personal loans downtrends into the fall, and searches for Lending Club also downtrend into the fall. So let's see, let's remove that. So yeah, personal loans also downtrended into the fall, or not, sorry, not fall, winter. But it's actually like not doing too poorly. And in the past 5 years, this makes sense because they pretty much halted spend on marketing in 2020 so that they could make sure that they could acquire the bank. They wanted to make sure that acquisition was able to go through. So they pretty much stopped all their marketing funnels in this period. So I'll say like this is okay. I'll say this LC2. This is LC1. And then this is where, I mean, despite the fall in auto loans and personal loans, this is pretty good. This is open up their marketing channels again. Wow, that is ugly as heck. Open. I'll call that LC3. Okay, so not terrible. And then look at credit card debt. Just writing some notes here. Oh, what's up, guys? 15 people? Nice. Nice to see you. Hope you're learning something. Okay, so lower in 2022, let's do marketing. So basically what I learned from that is that it's not too bad for a lending club as they're not entirely correlated to auto loans, but auto loans is a new product that's supposed to be like a growth driver for them. So that could put a damper on their forecast or their guidance when they report tomorrow. And guidance is going to make or break tomorrow's report, in my opinion, in many people's opinions. Credit card debt, downtrending. Interesting. That one is a puzzler. Cause well, I mean, on one hand you could say that these companies, Upstart, Lending Club, they've been doing super well since 2020 in terms of their financials, but searches for credit card debt have been down. So question mark? Credit debt. Interesting. Just making some notes on my script here. Been downtrending since summer 2019 or fall 2019. Could just be it's the wrong thing to search. Yeah, Google Trends is a handy little tool. Pay off credit card. Let's see if that gives us anything. It's pretty stable. I'll call this payoff. More refined search such as payoff credit card gives us more stable. Cool. Oh yeah, Daniel, thanks for the suggestion. Yeah. Interesting. Okay, last one, credit card loan. That's been dropping off as well. What the? And that kind of started maybe 2019. So like what happened in fall 2019? Or I guess better question is, why did the pandemic cause a decrease in search for credit card loans when rates were super low? Everyone was flush with cash. I mean, maybe it was because of stimulus, but you could also argue that the stimulus would make people want to spend more money, and then they're actually more likely to get into credit card debt because they're starting to spend. So like, yeah, I don't know. I guess it depends on how you think stimulus affected consumer spending and psychology, maybe. Like, if they have more money, are they more likely to go into credit card debt because they're on a spending spree, or are people going to handle it responsibly? To be honest, I would bet on the former. Let's see. What is this one? This one is credit card. Card loan. I'll call it card loan. Yeah, that's ugly. All right, interesting insights. So next thing I want to do is look at Wesley Punt said a lot of credit card offer special promotions during the holidays. Amex, for example, allowed you to add any purchase over $100 to a 24-month pay it back plan with 0% interest and no fees. Interesting. Thank you for that, Wesley. I mean, I guess that does make sense. So you're saying these special promotions help them reduce the amount of credit card debt that they would have theoretically. But again, it's like if people take advantage of that promotion, the odds that people spend under 100 or equal to 100 versus a little bit over 100, I don't know. This would probably require some more digging. But also that doesn't quite explain why it's like a multi-year downtrend instead of like a seasonal. Like that might explain the personal loan seasonality that we saw here, because that peaks in the summer, downtrends like December as maybe they start launching promotions and stuff. But yeah, interesting. Anyways, also for some reason, guys, when I look up like blank stock, the results just don't show up. But when I look up like ASDF, like it shows up, which is really weird. So, okay, let's see. LC, what am I looking for? Regional bank report, earnings reports. So I want to see like what the regional banks are talking about in their conference calls. Oof. Not ideal. This was reported on the 20th. Okay, EPS missed. I think Goldman also had higher expenses and missed as well. Okay, let's go to there. Bank earnings reports. Let's do that. Bank of America, corporation, company earnings calendar. Bank stocks. JP Morgan, Citigroup, Wells Fargo put better than expected fourth quarter earnings early Friday amid Federal Reserve's plan to raise interest rates in the coming months and Omicron's impact on the economy. JP Morgan stock and Citigroup fell. Wells Fargo stock advanced. The reports come as expectations for Federal Reserve policy changes send bond yields and interest rates higher. Higher interest rates benefit banks, which make more money on the loans that they extend. Right. So it's like, it's kind of tricky. Okay. Let's keep reading anyways. CFRA research analyst Kenneth Leon says in a recent note to clients that consumer loan activity is improving but is still below pre-pandemic levels. See, that's what we're looking for. Consumer loan activity is improving but is still below pre-pandemic levels. In March 2020, bank consumer loans peaked at $859 billion. Bank consumer loans peaked, and then fell $743 billion in April 2021. December 2021 bank consumer loan are just under $800 billion. Okay. Cool. Interesting. See, this could give us a hint, maybe. Like if the guidance from a lot of the banks is really good, then guidance for LC might be good as well. But these stocks fell, which makes me think maybe their guidance wasn't that good. So let's keep reading. And then once my plan is like once I find a few banks that I want to look at, then I'll probably go to their conference calls and see what they said about the impact of interest rates on consumer loan activity. Let's see. How many people we got on the stream now? 16 people. Nice. Yeah, feel free to subscribe to this weird channel that I don't know what I'm going to do with it, but I might start doing like updates on other projects I'm working on, basically allow you guys to get to know me a little bit better. Also, I'll do like maybe live streams like this, and I'll probably start doing maybe like vlogs or something where you guys can see what I do on day to day, because YouTube, investing, and investor community are like a really big part of my days, but I'm also working on a couple other projects that I think are really interesting. Kind of startup based stuff. So yeah, feel free to subscribe. And you'll also be alerted when I do a live stream like this in the future. Okay, meanwhile, big banks will also be affected by slowdown in consumer spending as inflation. Meanwhile, big banks will also be affected by a slowdown in consumer spending as inflation spiked in Q4 and Omicron ripped through the country. So a slowdown in consumer spending is not good. For LC. The near term brings uncertainty and some weakness about the path for consumer spending due to the seasonal slow period and potential Omicron effects. We think this is maybe transitory if the Omicron variant can be put under control, especially as we head into the 2022 spring season. Okay. Balanced outlook in a way. Kind of short-term pain, long-term gain idea there. Investment activity continues to be brisk. Equity capital markets activity was up 19% year over year to 1.3 trillion. Strongest period since 1980. Equity trading volumes, transaction fees, equity flows. I don't really care about that for now. Okay, estimates. Facts out 103 per share. Okay, this isn't quite what I'm looking for. I'm looking for more guidance, but this is a little bit what I'm looking for. All right, meanwhile, big banks must be affected. Slow down. So this is how I do my thing. File, save as, and this would be Outlook 1. Oh, shoot. I meant to do a 1. Uncertainty when spending due to the seasonal celebrating Omicron effects. Outlook 2. Okay, and then high interest rates, my money is extended. Matt, sure. What's up, man? Yes, it is. Trying to get a video out today for Lending Club. The people want to know what's going on. Let's see, JP Morgan. Net interest margin expected to fall year over year while rising modestly on a sequential basis. Total revenue is expected to rise marginally year over year amid anemic loan growth over the past year. Okay, so basically anemic just means weak, I guess. Are these like bots in the chat? No. Okay. I'm going to remove that. I guess. Remove. Okay. So yeah, this is not great. Net interest margin, I believe, if my memory serves, is the difference between the interest rate that the bank or like lending club is earning on the loan minus the interest rate they have to pay out to the interest rate they're paying to the people who've deposited with them. Because when you deposit money with lending club in like a checking or savings account, they pay you a certain percentage. Like, you know, it's the interest rate you earn on your savings accounts and stuff like that. So that costs them money to actually basically ask you to keep your money with them. Then they take your money and then they loan it out elsewhere at a higher rate. So that difference in their cost and then like the rate they're earning, I believe that is the net interest margin. So basically like a profit margin, I guess, on their loans in a way. So to see that fall is not great. Headwinds. Higher expenses. So are these higher expenses from wage inflation or from, let's see. That's terrifying. Driven by inflationary pressures. The bank will benefit from the rising interest rates on loan growth that have attracted investors to the financial industry in recent months. Net interest income is likely to hit roughly $50 billion this year, a gain of $5.5 billion from 2021 on the anticipated rates. High single-digit loan growth, Barnum said. we remain optimistic on U.S. economic growth. Last year, loan growth was challenged, but analysts have pointed out a rebound. Let's see what they're talking about here. April 14th, 2021. Okay. All right, so let's see. What can we take away from this? Oh yeah, here we go. Just to confirm what I said before, net interest margin reflects the difference between the interest banks earn on their assets and the interest they pay out to depositors and other creditors. Yep. It's predicted to decline year over year while rising modestly on a sequential basis. So, J. Morgan shares like blah, 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 blah. S&P 500 earnings history. Key stats. Oh, they expect a modest pickup. Okay. Let's see. I guess wouldn't rising rates benefit net interest margin because they would make more money, they'd charge higher rates. Do higher interest rates affect interest? Imagine it would be beneficial. Smaller net interest margins for financial intermediaries when the market interest rates increase, the bank's funding costs rapidly increase relative. Okay, so corporatefinancinstitute.com says higher rates. When the market rate increases, the bank's funding costs rapidly increase relative to their interest income and will reduce net interest income, higher rates. But then this says a decreasing level of market interest rates compresses the net interest margin. So they both, one of them, they're contradicting each other, unless I'm reading this wrong. Because I would assume that net interest margin would improve if rates increase. or I guess why wouldn't it be the same? But I understand why if rates are kept near zero for an extended period of time, that would probably decrease net interest margin because banks would have to get more competitive in the loans that they offer. All right, let's see. Federal Reserve Bank of Richmond from 2016. Many market participants assume that as the Federal Reserve tightens monetary policy and market rates increase in response, banks will be better off because their net interest margin will also increase. As a way to understand the origins of this expectation, in this economic brief, we'll look at the relationship between the federal funds rate and the average net interest margin for U.S. banks since the mid-1980s. We find that relationship is not as clear-cut as one might suspect. Okay, this looks like exactly what we need. There are, in fact, cases of rate hikes that did not see a corresponding increase in the average net interest margin, and sometimes higher rates have produced shrinking net interest margin for banks. These preliminary findings suggest that more research is needed to understand the effect of monetary tightening on system-wide bank profitability, and in particular, net interest margins. Anyone else find this interesting? I think this is pretty interesting. But I guess that's why you guys watch the videos, so I can just tell you what I find in these things, so you don't have to do it yourself. But yeah, for whoever's watching, I might end the stream soon so I can really dig into this. I've been going for just under 40 minutes, which I know I said I'd be for an hour and a half, but I feel like I'm able to focus better if I'm not on stream, but we'll go through a few pages of this together. I'm just able to move faster if I'm not on stream, I think. Daniel says it's interesting. All right, cool. We'll keep going for a little bit longer than Daniel. Just you and me. All right, these preliminary findings about importance of maturity mismatch. Due to frequent confusion between bank profits and net interest margins, it's important to review the meaning of the terms. Net interest margins are the spreads between what banks receive on their interest-earning assets and what they pay on interest-paying liabilities, divided by total interest-earning assets. Okay. Profits, by contrast, are adjusted to account for non-interest income, operational. Yeah. So basically what they're saying here is that, when rates rise, and if you see maybe all the bank's profits rise as rates rise, that doesn't necessarily mean that their net interest margin is also rising. It could be non-interest income that's contributing to higher profits in those scenarios. The pronouncements noted above reflect a widespread view that net interest margins will rise in tandem with interest rates. Historical data aside, however, there are reasons to think that this may not actually be the case, and the more traditional approach to banking liabilities are likely to be more interest rate sensitive than assets. One main reason has to do with the difference between typical maturities of assets and liabilities, often referred to as maturity mismatch. One main reason has to do with the difference between typical maturities of assets and liabilities, often referred to as maturity mismatch. Some examples of bank liabilities are consumer and business deposits, which tend to have relatively short-term maturities. By contrast, bank assets, for example, business loans, consumer loans, such as mortgages, often have longer-term maturities. Short-term rates track the Fed fund rates more closely and are more volatile, so one would expect these yields to be the most affected by policy-driven increases in interest rates. If the policy rate increases, banks would pay out more interest. Daniel said the margin might not increase, but revenue will, correct? Yeah, so basically what they're saying, I mean, that's not always going to be true, but I think the misconception that they're talking about where it's like higher rates is good for banks, like that might be true, like revenue might increase or profits might increase, but net interest margin, that specific area of their business, might not be where those increases are actually coming from, because their net interest or like maybe for some reason net interest margin drops, but the demand for loans increases faster than it like counteracts the drop in net interest margin with higher demand. But usually I don't think that would make sense. Like if rates increase, it's generally accepted that demand for loans would drop because it's more expensive to borrow money. That's kind of why they raise rates, is to it's contractionary, to like kind of slow down an overheating economy, to slow down spending. So that wouldn't really make sense. But yes, just because bank profits increase or bank revenues increase doesn't mean that it's because the net interest margin is increasing as well. That's what they're trying to say. Yes, exactly. So Dan says, yeah, because costs go up as well, and they themselves have to pay higher rates also. Yeah, exactly. So like if rates go up, then you should expect higher interest on your checking or savings accounts to be paid to you by the bank. But you should also expect to have to pay more for loans from the bank. So the bank gets to collect more money on their rates. So yeah, revenue might increase. However, their net interest margin might decrease because they also have to increase how much they're paying out to the depositors and creditors. So yeah, I think you got it. Some examples of bank liabilities are consumer and business deposits, which tend to have relatively short-term maturities. By contrast, bank assets, for example, business loans or consumer loans such as mortgages, often have longer-term maturities. Short-term rates, I already read through this. So one expected yields, if the policy rate increases, bank would pay out more interest on their liabilities while the rates on their longer-term loans would remain stable, effectively narrowing. Okay. So what I think they're saying here is that the liabilities, maturity mismatch is like, what is the maturity or the length of the loan for the expense side, like the income expense or the interest expense side and interest income side. So on interest income, it's a lot of like longer term loans, like mortgages, like which can last like 30 years, I think on average, on like standard 30-year fixed mortgage. But on the income expense side, where they're paying people who have deposited their money with the bank, that rate, that maturity of those considered liabilities is much shorter. So they're much more sensitive. So like, so to give you an example, if rates rise tomorrow, you would expect that your interest rate that you're receiving as someone who's put your money into the bank should also rise pretty soon. It's very sensitive to change. However, the loans that the bank already has that they're collecting interest on, that have much longer, like multi-year maturities, multi-year length, unless they're variable loans, I think they're called, then their rate is not quite as sensitive to changes in interest rate in the short term. So therefore, in the shorter term, it narrows the net interest margin because the rate that they're paying out is sensitive to change, and the rate that they're receiving is not as sensitive. That's pretty interesting. That makes sense. Okay. In the 1970s and 1980s, this maturity mismatch was one important factor behind the struggles of the savings and loan industry. A core business of the savings loans was fixed-rate mortgage loans. See, there we go. Wow. Amazing. which have returns that do not change when short-term rates move. So it's a fixed rate mortgage loan, which means that, okay, you're locked in at this rate for like the next 10, 20, 30 years. But if the rates increase, then the people who have deposited money that I have to pay out like on a monthly or annual basis, their rates go up, but the money I'm making on this fixed rate mortgage loan, that rate doesn't change. So now my net interest margin has decreased because, yeah, you're basically spending more for the money that you're making. Your margin just decreases. I think I'm just repeating the same thing. Okay, let's see. Oh, 12 viewers now. Nice. As interest rates increased rapidly in the 1980s during the Fed's anti-inflation campaign, the interest rates paid to depositors increased fairly quickly, while rates on savings and loans earned on their portfolios mortgage changed little. Instead of widening, net interest margins collapsed. This episode provides an admittedly extreme example of the fact for the traditional banking business of maturity transformation. Yeah, it doesn't sound great for lenders. But when we're thinking about Lending Club in particular, you think about most of their loans and their maturities. Oh, snap. Okay, it all makes sense now. It all makes sense now, guys. Check this out. So, I sent some research a while back on LC. Or maybe it was here. Back in December. Okay, here it is. So, as promised, notes from Credit Suisse X Lending Club Fireside Chat. By the way, check out Investor Community if you'd like. I don't have a link in the description, but you can look it up if you would like. So, we said interest rates. Rising interest rates are generally good for banks. Okay, that was before I read this paper. Putting loans on the balance sheet. Their loans are pretty short term, so you don't expect a significant impact from rising interest rates. See, it all makes sense now. Yay. They're repricing so fast that swings in interest rates won't matter that much. So their net interest margin will not be affected as significantly as like a traditional bank that does a lot of fixed mortgages or like long-term loans. Exactly. Even the new loans with increased rates would be refinanced once rates drop again. Yeah, so I think what Lending Club is saying is that because our main bread and butter is personal loans, credit card loans, of much more shorter term stuff, they're able to reprice the rates for the money that they're lending out and earning interest on at a much faster rate, so that the lag or the maturity mismatch, look at that, we're freaking, what's the word? Academics now. Wow, that was a little ironic. But the maturity mismatch is not as significant with Lending Club because they're not doing like 30-year loans. They're doing maybe like 1 to 2 year loans, right? Or maybe like even like 3 to 5. What's the average? What is the average length of a Lending Club loan? Credit card loan. 36 months. Oh, I feel like that's a long time. APR range is determined on the application. Really? Let's see. Is Lending Club scammers make contact? I'm just curious what people are saying. No. Yay. Okay. Personal loan rates and fees. Lending Club. Exactly, Daniel. So Lending Club has a quicker turnover of loans, which means they can adjust more quickly to rising or changes in interest rates. So monthly payment examples, APR. And I think variable rates would also be good for the banks in these situations. How can I use a personal loan? How am I going to check? All right, what's best to... Okay, where is the thing I'm looking for? let's see. I'm pretty sure maybe it's actually in here. Yeah, 36 months is probably pretty short when compared to the rest of the industry or like typical loans or consumer loans. Because they're so short term, so however, generally speaking, gets lower. Higher interest rates is contradictory and most else is not. Valuation, no recurring revenue. However, LCL form of recurring revenue, the more profitable they'll start. It's not quite bullish, also not quite bearish. I have to keep researching next quarter. I would say it's net neutral. I really want to see, like, if they have. Okay, let's see. Lending Club IR. I want to see if they have anything talking about their average length of their loan. Fourth quarter, moment of truth right there. Oops. Let's see, is average in here? Okay, average consumer loan balances, average commercial and PPP loans decreased, average total deposits grew. No, thank you. Loan progression, average mix of our loans that typically go to banks where a representative sample of the loans growth in the market. You're a little anxious about earnings tomorrow? I mean, whatever happens, happens, you know? Got to make sure that you're just making the best decisions with the info you have at this time. And that's why we're doing this, you know? It's also already come down so much. It's crazy. Our average consumer loan balances. Oh, this is just the beginning. I wonder if they have. Okay, so let's say length, time. Great. Oh, I've read this report before. Let's see. I want to see presentations, please. I want the presentation. Where is it at? Nope. there we go. No. Non-interest expo. Nope. All right, well, this is their guidance. I mean, that's worth grabbing. So I'll grab new. They had a pretty incredible year. They went from guiding for a loss to literally making 20 million in one quarter, which is pretty cool. But yeah, they went from guiding for a loss in 2021 to a pretty nice profit. All right. Well, it doesn't look like they have any information on the average loan length. So yeah. All right, guys. I'm gonna end the stream here. Matt says, "Oh, it shows they have 3 to 5 year personal loan options." Yeah. So we saw that. We saw on their it was 36 or 60 months, 3 to 5 years. If anyone has any experience, I guess how long is the average consumer loan? The most common mortgage loans are 15 and 30 year fixed mortgages, unvarying monthly rate over the blah, blah, blah. How long is average personal? So how do personal loans work? Personal loans have an installment loan. That means you borrow a fixed amount of money and pay it back with interest monthly payments, which typically range from 12 to 84 months. See, like 12 months would be nice. It sounds like in this environment, as a bank, you want to be able to have that sensitivity. And then in a falling interest rate environment, you want to be more fixed and long term. So in that case, wouldn't falling interest rate be good for banks? Because they would have fixed rates at a higher rate, and then as rates fall, they can pay less and less to their depositors, so that would increase net interest margin. And they would get more loan demand. What the heck? Why does that go against the typical thinking? Let me know what you guys think if you have any thoughts on that. Okay, unsecured. Okay, secured. We know that. Credit union, online leader, peer-to-peer, personal loans, auto lending options, impact your credit score, interest and fees, next steps. Okay, not helpful. Yeah, right. Doesn't that seem to make sense, Daniel? I don't know what I'm missing. I'm getting all twirled around here. Okay, consumer credit. Hey, Enders. Welcome, man. Welcome. Yeah, things will be very interesting tomorrow. Right now, we're trying to figure out how rising rates will impact the net interest margin for Lending Club. And we're going through a very fascinating report here on do net interest margins and interest rates move together? So consumer credit outstanding. Actually, I just got Daniel asked, do you think it's likely the Fed won't raise rates, and what would the stock market impact be? If they don't, I think they will raise rates. The Fed is definitely going to raise rates this year. It's just a matter of when and how aggressively. Yahoo Finance just sent me a notification, FOMC preview. Fed not expected to raise rates this week, but that's just a preview. It's not actually definitive. They're kind of guessing, it looks like. What the heck? LC's taking off. Where are you going? Well, I guess the market kind of rebounding as a whole. But LC and Upstart, loving it. Oh. Wait. Was that definitive? No. The meeting's not till tomorrow. Right? Anyways, all right, guys, I'm gonna end the stream here. I was supposed to, so I'm like doing this thing where I'm tracking all my hours, and I was only supposed to. Oh, actually, I have another. I'm supposed to be recording this video in the next 4 minutes. So I've been spending a lot of time researching. I'll probably start recording this soon. Hopefully, I'll be able to get it to you guys by the end of today on the YouTube channel. So thanks for joining me on the live stream. Really, really appreciate it. Had a great time. Hope you guys learned something. And yeah, good luck to all the fellow LC shareholders out there. Tomorrow, big day for us. So fingers crossed. I hope you enjoyed the session. Let me know if you guys want me to do more of these. Don't know how often I can do them, but this was pretty fun. Appreciate you being so engaged, Daniel. Having a little bit of a back and forth with me definitely makes it a little bit more fun. Oh, So Good So Bad from Discord. What's going on? Of course, I'm glad I could help. And yeah, I'm going to keep digging into this one. If anything, it's just beneficial to obviously know more about Lend Club and banks in general. Like when you research these stocks, you definitely want to research, of course, their industry, but that can also help when you're looking at different investment ideas within the same industry. And then remember, like, you know, we're looking at the bank forecasts and stuff. And remember that if you can apply this to other companies as well. Like if you're investing in a company in a certain industry and there's people in that industry who are reporting before them, take a look at their forecasts and see what they think about what's going on. And that can give you some insight into what your company will report, perhaps. So yeah, thank you guys. Thanks for stopping by. And I'll see you in the next one. Peace.